Walgreens has been absolutely hammered. It is down nearly 50% over the last 12 months and currently trades right there at its 52-week low. Now, it does offer a yield, although they had a recent dividend cut of around 5.34%. So is it undervalued? Is now a great time to buy this at the bottom? Let's find out in today's episode. We're going to run through, as always, looking at their numbers. We want to see if their top line revenue as well as their bottom line net income is growing. We want to look at their balance sheet, a quick health check, total cash versus total debt. We'll also see how they've performed versus the industry. Is this an industry-wide issue, or are other companies and competitors also facing similar downturns? We'll also look at the institutions, whether or not they're still buying quarter on quarter with this company. And we're going to briefly touch upon some notable insider buying that we have seen from the global CFO, which is typically a very bullish signal. We're also going to run through, quite importantly, their dividend safety, which does seem to be low even after their more recent dividend cut, and look at the supporting financial metrics such as the free cash flow and their debt levels. And as always, we will run Walgreens through the valuation model. We want to get to our intrinsic value. We want to see what our acceptable buy price is given our margin of safety, and we'll also look to Wall Street to see what upside they forecast over the next 12 months. Firstly, let's recap this company's historical performance. Now very poor, down 47% over the last 12 months. Just year to date, they have continued their downward trend, down 28%. And if you've been a holder, unfortunately, over the last 10 years, you would be down 71%. Now, it doesn't include those dividends reinvested, but whichever way you spin, this would have been a very poor investment over the last 10 years. It does trade now near its 52-week low, as we can see. Does offer a fairly decent starting yield, and we can see a forward P very, very cheap at 5.74. But again, we can't look at this purely in isolation to decide whether or not it is undervalued. So let's take a look at their numbers. Now, on the top line, we do want to see, even for a large mature company like Walgreens, 3 to 7% year on year. August 2019, 120 billion is what they reported. August 2023, so their latest annual accounts, we can see 139 billion. So they have increased over the last 5 years. What we do know, a little bit of inconsistency, so relatively minimal movement on the top line from 19 to 20. Then we see a nice increase into 2021, then remaining fairly flat, and then increasing into 2023. Now, we will also look at the last 10 years in percentage-wise to understand if they are meeting that baseline criteria that we have set. Now, in terms of the bottom line net income, well, not a great story. 4 billion reported in August 2019. We see a 3 billion loss reported in 2023. And when we look at it numerically and in granularity, we can see a decrease into 2020 before an increase to 22 and then decreasing. So top line and bottom line are looking very inconsistent, not painting the best of pictures, so we can understand why this company has plummeted down nearly 50% just over the last 12 months. Now, in terms of the health check, well, their cash position has gone from 1 billion in 2019 to 676 million. So their cash position has decreased over the last 5 years. Looking at the total debt numerically and directionally, what we have found is that in fact it has increased, in fact more than double, from 16.8 billion to the latest quarter of 34.6. So a little bit of a red flag already, but we will consider this in our metrics and dividend safety. But their cash has dropped, which is very small in comparison to their total debt, which has more than doubled. Now, as far as competitors go in a similar industry, we have a few well-known companies that you can see on screen. And when we take a look at their performance, this includes dividends reinvested. We can see Walgreens, in fact, the worst performing by quite some way, down negative 42%. And we do know only 2 of them out of their 6 have actually returned a positive performance. Now, when we extend that to the last 5 years, we do see again Walgreens the worst performing, but we know every single one, every other competitor or company in a similar sector and size performing on a positive return. So it is an isolation. This company has performed very, very poorly. In terms of institutional ownership, well, we see 59%. we see 1.7 billion worth of shares sold by these institutions over the last 12 months, with a little bit more buying over the same period. When we do look at it on quarterly basis, we can see in fact pretty much every single quarter institutions have been buying more shares than they have been selling. Q4 looking fairly flat. So something to consider, but it isn't something we should base our entire investment decision on. But as always, we do include it as one layer of our research. Now, as we mentioned at the beginning of the episode, a fairly bullish signal is when we see insiders buy, and notably we see here, and in fact this was only 2 days ago, we do see the Vice President and Global CFO, the Chief Finance Officer, had bought 6,000 shares, around $19, 116,000 worth, and we can see though since then the share price has come down around 3.5%. As always, the only reason why they buy is because they do believe the price will rise, hence why we do consider it a bullish signal. But remember, always do your own due diligence and never copy what insiders do or even what the institutions do. Now, as always, just to let you know, we have released our latest free weekly article. If you do want to gain access to this as well as others, all completely free, do click on that pinned comment and you can get started and read along. Now, in terms of the dividend safety, the score here is 30, and this is after the dividend cut that we did in fact see at the beginning of this year with a score of 30 unsafe. Market cap 16.1 billion is a large cap company. Now, in terms of looking at the metrics of the last recession, they did in fact increase the dividend. They had plus 5.6% sales. Remember, the average of the S&P was negative 12, and they also did a little bit better in the recession return period, negative 44, with the S&P bringing a negative 55% return. Now, in terms of dividend growth, we do see a negative 48%, or so a dividend cut in January this year. 3% over the last 5 years. Remember, on this channel, we do advocate, as always, 4% a year increases in your salary, your dividends, your other income producing assets, just so that you at least keep up in line with inflation. If you are getting less than 4%, you are taking a pay cut and losing purchasing power. Nice to note that over the last 20 years, the dividend has on average increased by 13%, but when you factor in that the share return is down nearly 70-80% just over the last 10 years, this isn't something really to be proud of. In terms of increases, well, again, no surprises, 0 years given that dividend cut in January 2024. Now, in terms of looking at dividend yield theory, as always, it does state the company is undervalued when the current yield sits above the 5-year average, but it isn't something we look in isolation and make our investment decisions of. It is just one level of our research. We also note the forward PE is much lower than the 5-year average of 8.7 and also significantly lower than the consumer staples of 20.5. Now, as always, we do prefer to look at the free cash flow payout, and this is very important. We do believe the earnings is susceptible to manipulation by management through accounting, and if you had just been looking at the earnings over the last 10 years, you would have been fairly happy if you were looking at a 50 to 60% maximum target. If you were looking at the free cash flow, well, you would have spotted a dividend cut incoming, as 2023, their free cash flow payout 1,175, indicating that management paid out far more in dividends than they generated in free cash flow. Positive to note, though, it is coming down to 46% in 2024, but again, one of the reasons why we do prefer that free cash flow payout as a metric as opposed to the earnings. Free cash flow per share, very inconsistent, and in fact on a decreasing, as we see it going from 2.92 to 0.16 in 2023. Now, it is expected to rebound back up in 2024, although it will be lower than 2022. Something just to note, isn't a company that is producing increasing free cash flows, but then again, no surprises, we weren't expecting it to, given the actual really poor performance over the last year and over the last 10 years. Sales growth, well, 3 to 7%, as we did mention earlier when looking at the top line growth. Very inconsistent over the last 10 years. We see some years of flat growth, 0 to 1%, and we see some years of negative growth. In terms of their best year, you have to go all the way back to 2015, where we saw double-digit 35% growth. And numerically speaking, whilst it has increased, we can see over the more recent period, it is increasing very minimally. And if you do factor in that 4%, or in fact that 4% inflation rate, in real terms, their top line isn't really increasing. And the reason we use that 4% is because the average US inflation rate over the last 40 years was 4%, hence why we always use that number. Now, in terms of shares outstanding, the one positive thing to note is they do return some excess cash to investors by reducing the share count through share buybacks, as we can see going from 965 to 863, initially meaning that you have more control or more of a position in a company as those shares outstanding do reduce. ROIC, I want to see 10% or more. If you want to be consumer, retail, industry specific, you might look at 17%. One thing we do want to note, it has been decreasing again. So lots of signs that the company isn't necessarily trading lower for no reason. There are reasons that you can purely spot just on some of these metrics. The ROIC being one of them, down at 3%. In terms of the margin, again, very, very poor. We want to see a minimum 10%. We see it, in fact, go from 5 down to 2 in 2023. And one of the reasons why we do see that net loss, if their margins are reducing, then it gives little breathing room for them to turn around a net income. Hence why this is one thing you should always keep an eye on in any company. Trading 12 months at 1% isn't a very good sign. We do want to see this go back up at a bare minimum to the 5% we saw over the last 5 years from 2014 to 2018. Free cash flow margin, something very similar as well to pretty much talk about, 0% in the more recent year. So they do really need to turn around this business. In terms of the net debt to earnings before interest, tax, depreciation, amortization, the EBITDA, we do want below 3 for consumer retails and the majority of companies we review on the channel. We can see it has been increasing. Remember, this is the number of years it would take the company to pay off all of their debt net of cash on hand. The fact that 3.69 is above the 3 maximum we want to see and is expected to go higher in 2024 is one of the reasons why we do see above that unsafe dividend score. So again, something just to factor in. It doesn't necessarily mean that this company isn't one you should invest in, but it will affect your margin of safety that we're about to come onto. As always, if you do enjoy the content and value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now let's jump into the first model that we're using for today's episode, is the dividend discount model. As we can see, the increase of the dividend year on year. Now we have noted that January 24 dividend cut of 48%. So on average, negative 8%. Forward looking, we've estimated around 2.75% based on the years where they were actually increasing their dividend. Again, subjective, different investors can input different amounts. And if you do grab a copy of this model in the pinned comments, you can play around with all these numbers that we are running through. So based on this, we get an undervaluation signal as we see here, the intrinsic value at 1957, slightly higher than the market value of 18.81. We then move on to the DCF model with the free cash flows year on year. Average growth rate at 2.6%. We have gone 8% in line with management estimates as well as analyst forecasts. With the discount rate, we get 8%, and we use, in fact, to get the present value of future free cash flows and terminal value, which we add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding, and we can see another undervaluation signal. Now, bear in mind the intrinsic value for today's episode is the average of these two models, coming to $21.15. Now, we always apply a margin of safety. This will depend on the investor, what number they want to use, but we start off with 10% as always. And we use that if we believe it meets 3 golden criteria: a wide moat, strong financial metrics, and good forward-looking data. So at 10%, it looks to be a buy up to $19.03. At 15%, at basically $18. It isn't quite there yet, so we see a 10 to 15% MOS level based on our estimates and judgments. In reality, for me personally, this is one that I am avoiding. It isn't one I want to add to my portfolio. It isn't one I would necessarily recommend to others to invest in. I do believe there are a lot of other opportunities out there to buy that we have reviewed on the channel just within the last week. But again, different investors will have different meanings, different ways that they want to increase their portfolio's income, and this could be one of them with the yield of around 5 to 6%. In terms of Wall Street and their forecast, well, over the next 12 months, they have a price target of just under $25. So they see this as a very strong buy now. They have upside of 32%. They believe that you are looking at a very nice yield now, as well as looking at upside in the strong double digits. As always, though, do let me know your thoughts in the comments below. Is Walgreens one you're looking to add? Maybe it's one you bought when it was a lot higher and you're just dollar cost averaging in so that you are reducing your average price. Or maybe similar to me, this is one that you are avoiding as well. As always, let us know your thoughts. If you enjoyed today's episode, smash that like button. Don't forget to hit that subscribe button and bell button so every time we release a video, you are notified straight away. As always, have a great day and see you all on the next one.